Hello everyone, this is Professor Anil Joshi. I am the owner of the portal www.commercefunda.com. I also have a Facebook page by the same name. So do keep watching my Facebook page. Today I am going to explain the concept of marginal costing to you. And what I have observed is, students many times find these chapters little difficult. The reason is they are learning only for the purpose of exam and not for the purpose of learning the subject. So today I am going to give you those tips whereby you will learn the subject and you will start enjoying also. So your objective should be to understand what you are reading and not just to score marks in the exam. So let me first tell you, what is this concept called marginal costing. As you all know, this marginal costing is a costing technique which is used in your cost and management accounting subject, right? Whether it is cost accounting exam or CA or company secretary, you have this course, you have this subject. So marginal costing is a costing technique. Now what do we mean by marginal? Marginal is nothing but when we say marginal cost, it is nothing but the extra cost that we incur for every one additional unit of production. So if my one unit is costing me say rupees 300, and when I produce 2 units, and if the cost is total 500, that means the marginal cost for this one extra unit is rupees 200. So I repeat, marginal cost means the extra cost, the additional cost that you incur for every one additional unit of your output or production. Now let me tell you, how the cost function overall flows in your P&L or in your cost statement. So you have sales minus the total cost is profit, correct? That's the simple equation. Now total cost consists of two parts, your total variable cost and total fixed cost. So let me rewrite this equation. So sales minus total variable cost minus total fixed cost is equal to profit, correct? Let me take this fixed cost portion to the right hand side. So my equation will become sales minus total variable cost is equal to total fixed cost plus profit, correct? Once we take this on the right hand side, this minus will become plus. Now this is the equation which is used throughout your marginal costing chapter. So once this equation is very clear in your head, you can solve any question in marginal costing. Then it is only a question of application of this equation in your practical questions. Now this sales minus total variable cost is called by a different name called contribution. Now let me tell you why this is called as contribution. What is sales? Sales is nothing but the extra revenue that you earn every time you sell more units. What is total variable cost? That's the extra cost that you incur whenever you are producing more. So sales minus total variable cost is nothing but the addition that you are making to your profit. Let us say that whenever I sell one extra unit, my sales additional selling price is say 100 rupees, and for making that one additional unit of production, my extra cost, that is variable cost, is 70 rupees. That means what is happening is every time I sell one unit, I am adding 100 minus 70, 30 rupees to my profitability, and that is nothing but my contribution. So my formula now becomes contribution is equal to total fixed cost plus profit. Now you must be knowing the formula for gross profit ratio, net profit ratio, etc. So how do we calculate that formula? How do we calculate that ratio? Gross profit upon net sales into 100. Net profit ratio, net profit upon net sales into 100. Same logic here also. So when you talk about contribution ratio, it is contribution upon sales into 100, right? So this is your contribution ratio, and this contribution ratio is also called by a different name which is called PV ratio. The formula, the long form is profit volume ratio, because contribution is nothing but the addition to the profit, and every time you increase the volume, your contribution increases, and that adds to your profitability. That is why the name profit volume ratio. So simple, you have to understand, you have to remember, profit volume ratio is nothing but contribution upon sales into 100. Right? Now let me ask you something related to this. So if I say that PV ratio of a particular product is say 40%. Okay. So now tell me, think and tell, try to find out what will be the variable cost ratio. Now it is very simple. So if you have understood this formula, this is very easy for you. What is contribution? Sales minus variable cost, that is your contribution. Contribution is a percentage of sales. So if my PV ratio, that is contribution ratio, is 40%, that means what I am saying is my contribution is 40% of sales. What does this mean? That means if my sales is 100 rupees, my contribution is 40. Now if my sales is 100 and contribution is 40, that means obviously my variable cost is 60 rupees, because sales minus variable cost is my contribution. So if my contribution ratio is 40%, that means my variable cost ratio is 60%. Correct? So what we have learnt is PV ratio plus variable cost ratio should always be equal to 100%. Always. And 100% is nothing but 1. So 40% plus 60%. 100%. If I say my PV ratio is 20%, that means my variable cost ratio is 80%. Alright? So this is about your PV ratio. Now let me use that same equation once again to explain to you break-even point. So just now we wrote contribution is equal to total fixed cost plus profit. Now what is break-even point? Break-even point is nothing but a point where you make zero profit, zero loss. So your sales are exactly equal to your total cost. That is why you don't get any profit, right? No profit, no loss. So at break-even point, what will this equation become? This is zero now. So therefore at break-even point, your same equation becomes contribution is equal to total fixed cost, because profit is not there and even loss is not there. Right? So this is the equation at break-even point. Correct? Now the question is, how do you find out the break-even point? Again, we are using the same equation. There is no rocket science behind this. So what is contribution? Contribution is nothing but contribution per unit multiplied by number of units is equal to total fixed cost. We are talking about only break-even point. Right? So remember, this equation is only for break-even level. So contribution per unit multiplied by number of units will give you overall contribution, and that is equal to total fixed cost. Now I want to find this out. So what will I do? I'll take this to the right hand side. So my number of units will become total fixed cost divided by contribution per unit. So this is how we find out the break-even level in terms of number of units. So whenever you want to find out the break-even level for your business in terms of units, this is the formula. What is the total fixed cost for your business for a particular period divided by contribution per unit? That will give you break-even level. And you know what is contribution per unit? Contribution per unit is selling price minus the variable cost per unit will be your contribution per unit. Right? So this is the break-even point in units. Similarly, you can calculate break-even point in rupees also. There are two ways in which you can calculate break-even point in rupees. One is, once you find out the break-even level in units, multiply that by the selling price, you will get break-even sales in rupees. Correct? Or if you don't want to use that way, Then there is another way you can calculate. So you will observe I am using the same equation. So contribution is equal to total fixed cost at break-even level. What is contribution? Contribution is sales into PV ratio, correct? Because this is contribution ratio, which is percentage of sales. So obviously sales into contribution ratio will be my contribution. That is equal to total fixed cost. I want to find this out. So I'll take this to the right hand side. So my break-even sales is equal to total fixed cost upon PV ratio. Correct? So this is the formula for calculating the break-even sales in rupees. Total fixed cost divided by profit volume ratio. That gives you the break-even sales in rupees. And this amount and the amount which otherwise you would have calculated by multiplying the break-even point in units and selling price will be giving you the same answer. The answers will not be different, right? Only thing is this is in rupees. The other earlier formula that we saw, that was for units, correct? So you will notice that here everything that we are talking about is coming from the same basic equation, correct? So that is what you need to remember. So this is about your break-even point. Now let me explain to you margin of safety. See, everywhere I am using the same equation. So what is margin of safety? Margin of safety is your sales, which is actual sales, minus break-even sales. So if I say that my actual sales for a particular period is 70,000 rupees and my break-even sales was 50,000, that means my margin of safety was 20,000. So this margin of safety is the extra sale that you make over and above the break-even level. Now let me explain to you something related to margin of safety and the significance of that margin of safety. So you know at break-even level your profit is zero. If you sell above break-even level, that means you are making profit, and if you are selling lesser than break-even level, that means you are incurring losses. That means if your margin of safety is positive, that means you are making profit. So this extra sale that you are making into PV ratio is nothing but the profit for that particular product. So we now are learning another equation. Margin of safety multiplied by PV ratio is nothing but the profit for your product or service. Now let me tell you the logic behind this. So I told you this margin of safety is the extra sale over and above the break-even level. You know at break-even level the profit is zero. And you also know that the contribution is addition to the profit always. So that means whatever extra sale you are making, on that whatever contribution you are making, which is margin of safety into PV ratio, that will add to your profit, which was originally zero. So in zero, when you add the contribution, that gives you the overall profit for the company. So that is why this formula. Margin of safety into PV ratio is equal to profit, right? Again, this is also coming from the same equation. Now margin of safety in rupees is calculated this way, sales minus break-even level. If you are talking about margin of safety ratio, then it is margin of safety again as divided by actual sales into 100, because it is expressed in percentage. So don't take break-even level, break-even sales in the denominator, it is actual sales. So if I say my margin of safety ratio is 20%, that means what? It is 20% of actual sales. So if my actual sales were 100, my margin of safety is 20. It is 20%. That means my break-even level was 80 rupees. Correct? I was making sales 20 rupees extra over and above the break-even level. That is what is margin of safety. So if my margin of safety is 20% of sales, that means my break-even level is 80% of sales. Correct? So margin of safety ratio plus break-even ratio, sales ratio, again will give you 100%. 20%, 80%, 100%. Correct? So that is the significance or the way of calculating your margin of safety and how it is related to your profitability. So remember, the objective of this session was to let you know that marginal costing is a very simple chapter. You just need to understand the basic equation, sales minus cost is equal to profit, and your chapter is done. And then it is only a question of practicing more and more on the application of this equation. Yeah. So I hope you have understood this, and I have helped you to make this chapter easy for you. So thank you.